Hi everyone, this is Mike Saky for Selling East Bay with another video on a local real estate market. This is the 2020 real estate playbook. What to expect in the next 12 months? Well, let's get it started. I prepared like about 14 slides. I will go over the facts, what you need to know, how to move forward with your local real estate projects or decisions you make on that note. And they are divided in external factors and internal factors affecting our economy, our local economy, and our local real estate market. So let's get it started. Before I start, I want to just apologize for one thing. I started this new software and I might have to go back and forth between the slides. So bear with me if I lose a slide and I have to go back. I do apologize in advance. So without further ado, let me start with my thoughts on this and move forward. The first thing I would love to share with you is to talk about the external factors. All these three could render different outcome as they impact the US economy separately or in concert. So as things are just happening, we have to see how things unfold. But definitely the 2020 elections, the stock market, and unemployment are the major on a national level issues that we need to consider when we talk about the health of the real estate or your local real estate. So let's start with the 2020 elections. Now, I didn't want to turn this into a video on politics because it's not. This is really considering the facts or the situations that will affect the real estate market as we are or where we are in US. So I do not believe that that matters who is going to be in the office. I think at this point, all the candidates, they are working on some kind of plan to address the 30 million unemployment number that we are facing as a nation. And I think the first agenda would be this in terms of whoever just, tries to do their best being in the office. And the major takeaway from this is one thing. So remember, the GDP relies on production hours in goods and services. So no work, no production hours. So a healthy economy needs to have, goods and services produced. If we don't have those, then the GDP is suffering. So we need to address the unemployment first. The next slide I would love to share with you is about the stock market. I wanted to really just, give you some understanding what's going on in the stock market, because sometimes the media use this as a way to put a kind of a positive spin on things that are happening. And I just want to make sure not to give you that kind of same spiel as we go through this presentation. I don't believe that what you hear in the media are 100%, real. And I will just hopefully be able to explain that to you as I go through the next slides here. So I see across the S&P 500, Dow, NASDAQ, only cross-hedging and shifting assets around minimum downside. So what trying to do is, the hedge funds, pension funds, and bigger corporations to park the funds and monies in safe places when we talk about stock market. And they usually put them in much more safer stocks, and those are the Teslas and the Facebooks, as we know. But I will elaborate on that in the next slides as we go through this presentation, what you need to focus to see how healthy the economy is at any given point. So when we are talking about a slice of the economy, or look what the corporations do in a situation like this, this is what we are facing right now. Victoria's Secret declared bankruptcy. Zara closed 1,200 stores. World's luxury brands like Chanel, Hermes, and Patek Philippe discontinued some of their lines or most of their lines. Nike has a total of $23 billion US dollars preparing for the second stage of layoffs. Not first, we're talking about second stage of layoffs. Starbucks has announced to permanently closing about 400 stores. WeWork, Airbnb, and Gold's Gym very much in trouble staying afloat. Nissan Motor Company, a huge automaker, may close down in US. Biggest car rental company, Hertz, filed BK. Biggest trucking company, Comcar, filed BK. JCPenney filed bankruptcy. And I believe they are in the process of being acquired by Amazon, which is ironic and also a topic for another show. Warren Buffett, one of the biggest investors in the world, not if not the biggest, lost $50 billion in the last 2 months. $50 billion is huge. We're talking about around $800 million a day. That's a big deal. The biggest mall in US, Mall of America, stopped paying mortgage payments. This is a good understanding, or what you look at is it gives you good understanding of what corporations and big companies are doing. They are bracing themselves for the recession and handling the pandemic and the COVID-19 crisis. So this is what you need to look at in terms of what it means to the unemployment numbers and the job market. Now, the next thing I would love to share with you is the fact that try to not look at Tesla and Facebook, Amazon and Netflix and Google as a sign of the stock market health. These are, as I said, just hedging instruments for the time being. Look at financial institutions like banks. Look at Wells Fargo. Look at BofA. Their stocks are down. Way down. Financial institutions are the backbone of the economy, not Facebook or Amazon. I would say there is a lot more than that. Now, the unemployment numbers are huge, no doubt about it. But the question is, how are we going to just address that? I want to put something in perspective. In 2019 alone, US in full swing continuously added about 200,000 jobs to the economy month over month. Now, in mid-2020, we have over 30 million unemployed workers. That's a huge deal. We need to get people back to work. How long do you think it would take to create new jobs and reemploy everyone? You do the math. I do not believe that you can put people back to work at records numbers as we used to do in September of 2019, October of 2019, or December of 2019, which used to be 200,000 jobs a month. So also I want to just make you aware of something else about the quality of the jobs. I do believe that you need to pay attention to when you listen to news and the media. You might hear that we have 50,000 new jobs added to the economy, and I want you to be aware of it that some of the jobs might not be real jobs. They are temporary jobs. They are jobs like driving for Uber or driving, delivering boxes for Amazon. So we need real jobs, we need real new companies and new expansions within companies that provide stable, sustainable careers for people when they go to work. This is a major deal that we need to address, the unemployment numbers. So the next slide is about looking at the internal factors within the real estate industry affecting the housing market, regardless regional or local. So the 4 items I put on this slide, I thought these are the most important things that you might want to know, and you have some understanding of it, but you need to know more facts about them. The number one, I think, is the homeowner equity. We're going to talk about and see, how much money people got locked in the property. That's important because that's a factor affecting foreclosures or short sales. The postponed demand on selling and buying, that's something that we need to address. Mortgage rates, we know they are low, but we want to know what it really means. And the government instituted forbearance and the foreclosure issue, I want to talk about it a bit because I think a lot of people temporarily think this is the panacea, but this is not the solution. This is really, we just froze the problem for right now. and until we figure out dealing with COVID-19 crisis, and dealing with people not panicking, and people still being at home, out of their not having any jobs, and they try to just kind of control the situation as we go. So let me just talk about each of those, and I think we wrap it up after that. Now, when we talk about the homeowner equity, we're talking about the home equities. The good thing is, according to available real estate data, comparing the 2008 recession to the 2020, you will see one major difference. Homeowners in the US, about 60% of them, have 50% or more equity in their properties. This is a game changer. People won't walk away from their homes because of the equity. So that means the likelihood that they walk away is a lot less, which means down the road less foreclosures and less short sales in the market. Now, the second item I want to talk about, we're talking about the postponed demand and what it means. In the last quarter of the 2019, still people were buying and selling. We had a lot of good volume of transactions going down. However, in January, we started, just having the halt with the COVID-19 and people panicking, and people stopped all their buying and selling in their plans because they needed to figure out what's going on, which makes sense. So the intent of buying and selling has not gone away. That is still there, but we need to just wait and see how the other things unfold in the economy to see people come forward and just take part in transactions in terms of selling or buying. But the one thing that helps the situation, as I would say, in terms of helping the prices, is the lack of inventory. That factor will hold up the prices as we go into the next months, which is a good thing. However, I do not know for how long. The next slide that I want to share with you is about the mortgage rates. I had my doubts to put that on this presentation. However, I thought you need to know not to just brag about rates are great and they're under 3%. Yes, it sounds good, but don't forget the roots. Only people who have jobs and have been continuously working at least for the last 2 years can take advantage of this historically low mortgage rate environment. So I don't want to be foolish about it, because I don't know of any government or Fannie Mae, Freddie Mac guideline coming down the pipe explaining that they would alleviate or provide leniency if you have had temporary job or a gap in your work history to be able to get a loan regardless as a first-time home buyer or an investor. We don't know that. So all I can tell you is right now, yes, 3% is better than 4%. However, if I have a buyer who doesn't qualify because they have a gap in their history, doesn't matter if it's a 3% or 1%, they don't get the loan. And that's a problem that needs to be addressed down the road, I would say in the next 12 to 24 months. The next item is the mortgage forbearance and the foreclosures suspension. I do think that the government instituted this mortgage forbearance to create more control, over the pandemic, and I mean the COVID-19 crisis and the recession, in order to see how it all is going to play out. As a good move, I would say that was a great move. However, as I said, we are not addressing the problem. We just froze the problem. We're postponing an antidote or the solution for the problem, which I have not seen anything in the picture yet. So you have to understand that people who have not been able to go to the workplace and they had to stay home and did not get paid, and they were not able to pay their monthly mortgage payments, they were able to use the forbearance option. However, at the same time, the government instituted a freeze on lenders and banks to report homeowners who haven't been paying their mortgages to the reporting agencies at late. So this is for now. I have no idea what is going to happen in the next 8 months or 12 months. I think this is something that needs to be seen because lenders and banks, they have all the obligations on the balance sheets. Without that money coming through the doors, through the servicing, they have to address their own obligations, and that is going to hit the wall, and that's going to be a problem. So my final thoughts on where we are and where we're going to go from here. I see a U-shaped recovery of some sort, and how U-shaped, I mean how long the U-shape could be or is or will be, is something that has to do with all the rest of the dominoes falling, meaning the unemployment, how the new administration will address the issues at hand, and how buyers and sellers still have the appetite to buy and sell. But what I can tell you, meanwhile, the money will flow from the stock market to the real estate. And after that, we will see some corrections here and there. But let me take a sip. And but the current low inventory, as it is, it will keep things in check in terms of prices. So, which is a good thing. I do believe that allows for people not to panic too much and be able to just, make sound decision as they go through buying and the selling process. Bottom line, the more jobs we create, the more stable the housing market will be. So that's my takeaway from everything that I've been trying to explain here. So let me know what you think, and I would love to hear your comments on that. By the way, let me know if there is any topic you want me to address, and I will make a video on it. Also, if you are not getting my newsletter, just get on my list. Just send me your email, and I just add you to my list. So stay healthy, be safe. Until next time, Mike Saky for Selling East Bay. Have a great day.